Hi, Edward here from Roni Deutch's YouTube channel. We've all heard the old saying, nothing is certain except death and taxes. For some Americans, the two become truly intertwined as when it comes to taxes after death. The rules are complex, and you usually only deal with them when you are suffering the loss of a loved one. So to help make sense of it all, here's what you need to know. When a taxpayer passes away, a new entity known as the taxpayer's estate is created to ensure no taxes go unpaid. The taxpayer's income will need to be included on their final tax return, which must be filed by April 15th. If there is a beneficiary, then he or she may be able to pay the deceased's income taxes on their own tax return. However, if the estate has a value of more than $600, then a return must be filed for the recently deceased taxpayer. The final tax return filing could fall into the hands of several different people depending on the circumstances. If the estate had an executor or administrator, then they are usually responsible for making sure the return is filed. But if there isn't an executor, then the closest surviving relative must take care of it. There are no special forms that need to be filed for a taxpayer that passes. Instead, the word deceased needs to be written after the person's name on their standard return. Many taxpayers trying to take care of recently deceased family members' tax return might not think that the April 15th deadline matters, but this is a big mistake. Even with the deceased person's tax return, the IRS deadline is still April 15th. Remember though, if you are running behind, then you can always request an automatic extension. Any deductions and expenses for the deceased person's return still apply. After the death of the taxpayer, the value of their property will be adjusted to its current market price. This is helpful for the person who inherits the property, because if they decide to sell, they will only owe taxes on any appreciation of the property after the death. Therefore, you need to validate the date of the death value as soon as possible, which can make the process even more difficult. A big misconception about inheritance taxes is that IRAs and retirement accounts are not subject to them. Unfortunately, this is not true. With an IRA inheritance, you can choose to retitle it as an inheritance account, roll it over into your own IRA, or have it as a separate account. The rules may be slightly different depending on your relationship to the recently deceased taxpayer. In most cases, taxes will still need to be paid on any distributions paid out of the IRA. However, it can get very complicated, and I highly recommend speaking with a qualified attorney to make sure you are fully compliant with both federal and state tax laws. While handling the affairs of a loved one who passes is certainly never easy, I hope this helps clarify some of the tax issues you will have to deal with. Thank you for watching, and stay classy.